If you are using a periodic method for tracking inventory, that means that all of your purchases to inventory are considered an expense on your income statement, and you adjust your inventory based on counts done periodically, which is typically once a month, once a quarter, or once a year, depending on your company. This means that at the end of the year, businesses using this method will need to make an adjustment to their inventory and record costs of goods sold. Let's see what that adjustment would look like. Let's imagine that your company currently has an inventory account balance of $140,480 on their balance sheet. But that number hasn't been updated all year because they use a periodic inventory system. So at the end of the year, you perform an inventory count and discover that your ending inventory balance should be $124,640. Also, all purchases of merchandise for the year were recorded in the purchases account on the income statement and totaled $326,000. To make the inventory adjustment, we first need to update the old balance in inventory of $140,480 to the new balance of $124,640. It is important to note that inventory balances can move either up or down from year to year, so the inventory account in the adjusting entry might receive a debit if inventory went up during the year or a credit if it went down. In this case, it went down, so we will want to credit inventory for the difference between the two balances, or $15,840. The purchases account is a temporary account used to hold all of the merchandise purchases during the year. This account is always reduced to zero during the adjusting entry. So if the purchases account normally has a debit balance, we would need to credit the account for the full balance of $326,000 to reduce the account to zero. This is what our adjusting entry looks like so far. It obviously doesn't balance because everything so far is a credit. The last account we need to add is our cost of goods sold account. The cost of goods sold account will always receive a debit value for whatever amount is necessary to balance the journal entry so that debits and credits equal. In this case, we need a debit of $341,840 to balance the journal entry. As a quick review, the adjustment for periodic inventory has three parts. First, you calculate the difference in the inventory account and debit it if inventory increases, or credit it if inventory decreases. Second, you credit purchases for its full balance so that the amount in purchases is zero. And last, you debit cost of goods sold for whatever amount is needed to balance the journal entry. To learn more about GAAP adjustments and other accounting topics, check out more of my videos on YouTube or visit ToriNorman.com.